Hello there, and thanks for joining me for the accounting and finance coaching session. I am Echela Okori, your coach, and today I want us to look at the IAS1, that's International Accounting Standard 1, presentation of financial statement, and the standard, the IFRS, that is to replace it in 2027. That is IFRS 18, presentation and disclosure in financial statements. Okay, so IFRS 18 will take effect from January 2027. Now, here's the good news. Early adoption of IFRS 18 is allowed. It means some companies, some firms have already started using IFRS 18. But from January 2027, that is the period that it becomes mandatory for you to discard IAS1. You throw it away and then you continue to use, or you begin to use IFRS 18. So it's very important that you know the major differences between IAS1 and IFRS 18. Somebody may want to ask, why is IFRS 18 replacing IAS1? The major reason is that IAS1 has faced a lot of major criticisms for being too flexible and also not showing enough comparability. You know, as I told you before, the essence of preparing financial statements, or the essence of accounting, is to provide users of financial statements with financial information that will help them make the best decisions. So basically, we prepare accounts to help users of the accounts to make the best decisions, so they can make decisions from the point of view of strength, from the position of strength. Good. Now let's look at the major improvements on IAS1. Basically, the IFRS, that's a standard, IFRS 18, wants some major categories to reflect on performance. You know that we have the statement of profit or loss and other comprehensive income. We have the statement of financial position. We have the statement of changes in equity. We have the statement of cash flows. And then we have the notes to the account. These are the major financial statements. They are the primary financial statements. Now, the major improvement that IFRS 18 is bringing actually pertains to one of these financial statements, and that is the statement of profit or loss. And so if I have the format, it's very important for you to know the format. But basically, before I move into the format, I want you to know that the first major thing that IFRS 18 wants to identify is that IFRS 18 wants users of the account to identify the operating category. Operating category. They want to show your operations, so that if I'm a user of the account and I pick up the financial statement, I look at the statement of profit or loss, I should be able to identify items, line items that pertain to operations. I should be able to see a total that shows me operations. So there's an operations category. Also, IFRS 18 wants us to be able, or wants the users of the account to be able to identify investing category. What are the investments that this account, that this company, whose account I'm looking at, what investment have they done? So you should be able to show the investment or the investing category. So you should be able to see that. Also, another one is financing category. The IFRS 18 wants users of the account to be able to go straight and look at financing category. These are the items, the line items that pertain specifically to financing activities, to financing, basically. Then also, the fourth one, they want to be able to see your income tax. Income tax category should be very clear. And then the last one, the discontinued activity. You should be able to see discontinued activity. So the basic 5 major items that IFRS 18 is bringing to the table, which might not be completely very new, as in absent from IAS1, but this time around, you want to see it clearly. You want to see the operating category. You want to see the investing category. You want to see the financing category. You want to see income tax category. And you want to be able to see the discontinued operations category. Now, Let's look at also, there's a format that has been made mandatory to be followed. This time around, there won't be flexibility. So that when you pick company A, B, C, you should be able to do comparability. You should be able to do comparison between them. Not that one looks slightly different and the other looks very, very different. No. So there is a mandatory format that must be followed. There are some subtotals that IFRS 18 has made mandatory. Now let's delve into the format. I just wrote it out here. So usually we begin with that's the statement of profit or loss. We begin with the revenue, your revenue, okay? Don't forget that revenue is governed by the standard, that's IFRS 15, which is on revenue with contract with customers. So you begin with your revenue. After that, the cost of sales will be shown as a line item. You go to your books and do your workings, your opening stock, card purchases, less closing stock, whatever, all those adjustments. You want to see only your cost of sales as a line item. After that, you remove cost of sales from revenue. What do you have? You have your gross profit. After gross profit, you ask yourself, do you have other income apart from the one you got from trading? If there are other income, you add it. If you have distribution cost, of course you will have distribution cost. You remove distribution cost. It's a deductible. Also, admin expenses is another deductible which will be removed. And then you have other admin expenses which may be there, which you may not have. But if you do, you also remove other admin expenses. And then by the time you remove all of this from the total that you have from here, the total of gross profit and other income, you have a positive figure. By the time you add distribution costs, admin expenses, and other admin expenses, you can now remove it. And what you have at the end of the day is what we call the operating profit. Now, this operating profit is very, very important. IFRS 18 wants to see it clearly. After that, you go straight to share of profit from associates. Associates, you know the category and percentages for subsidiary, associate, and ordinary investment. So if it's above 50%, you say it's a subsidiary, and of course there are other conditions that could also make it a subsidiary. But if it is a subsidiary, you know you have to consolidate. If it is an associate, you don't consolidate, okay? So you have to show the share of profit from your associate here, and it means you have invested in an associate. That's why you're having a share of their profit. Next, you also talk about income from investment properties. Do you have investment properties? You have income from it. You have to show it. So these two will show you what we call the investing category. That is the investing or investment category. Coming forward, coming down, we also have, when you do this, what you're going to have is going to be, the total will be the profit before finance and income tax. Now, this was not there in IAS 1. But now it is very important that you show the profit before finance and income tax. Before financing and income tax. The profit before financing and income tax is very, very important. It has to be shown. That is the requirement of IFRS 18. Now, if we delve further after that, under it, we are going to have interest expense on borrowing. Now, this shows that this is financing now. This is financing. Interest expense on borrowing, okay? So, another one is interest expense on long-term provisions. You know, to finance your business, you need to borrow. So, what are the costs? You have to bring in the costs here, basically your finance costs. So, this category, this area will show what we call the that's the finance area, to show the finance. Good. Now, after that, you will have what we call the profit before income tax. So when you adjust, make all the adjustment here, what you have at the end of the day is what we call the profit before income tax. Then you have to show your income tax expense. This is another area that has to be, that is, of course, it's mandatory. Even with IAS 1, it was mandatory to show your income tax expense. So after that, you will have what we call profit from continuing operations. Profit from continuing operations. That is the profit you have made from that aspect of the business that is not being phased out, that is not being sold, that is not being discontinued, you will have what we call the profit from continuing operations. Now, another major category that IFRS 18 wants to show is the discontinued operations. You have to show that category. So you have what we call loss from discontinued operations. You will show that. And of course, when you adjust that, what you have at the end of the day is going to be the profit for the year. So that is the major adjustment that IFRS 18 is bringing to the presentation and disclosure in financial statements. Another area that I want to talk about is the management defined performance measures. That's what we call management defined performance measures. Also, IFRS 18 makes it mandatory for the management, that is the directors of firms reporting companies, to show what we call management defined performance measures, not in the body of the financial statements, but in the notes to the account. You may want to ask, what do we mean by management defined performance measures? These are measures that management employs to communicate to their stakeholders. It could be like adjusted profit. It could be adjusted operating profit, whatever it is. You know, those adjustments that are not mandatory under international financial reporting standard, but which management needs to do in order to communicate to stakeholders to give them a picture of their performance. So management may say, okay, we know IFRS does not require this, but we need to do this. We need to adjust. We are reporting to our stakeholders. We need to adjust maybe operating profit, or maybe adjust the profit for the year, whatever, and communicate to their stakeholders in order to talk about performance. So if you do any of this, they are called management defined performance measures, and IFRS 18 requires that you state it in the notes to the account, not in the body of the account. So basically, they are about income and expenses. Management defined performance measures are about income and expenses, and they are done by management. They are like adjustments about performance, and management uses them to communicate, make public communication to their stakeholders. So basically, let me just do a recap. Don't forget, from 2027, January 2027, IFRS 18 becomes operative. It is going to fully replace IAS 1. IAS 1 is presentation of financial statements. IFRS 18 is going to replace it, and IFRS 18 is presentation and disclosures in financial statements. So it's going to replace IAS 1. But for now, early adoption is allowed. If you want to adopt IFRS 18 and replace IAS 1, the standard, that is the IASB, allows you to do that. The International Accounting Standard Board allows you to do that. Okay? You can do that. Early adoption is allowed. And even if you are not adopting it early, it is very important for you to understand it now. You don't need to wait till you get to 2027 before you start learning how to apply IFRS 18. And so we also offer trainings if you want your staff trained, so we can teach you the nitty-gritty and the major adjustments to IFRS 18. The ball is in your court. So there are 5 major categories to be shown in the statement of profit or loss as per IFRS 18. One is you have to show the category for operating. Okay? You have to show the category for operating, and also you have to show for investing. For investment, you have to show that category, your investment category. You also have to show the financing category. Then you also have to show your income tax category. And lastly, you have to show the discontinued operations category. If you enjoyed this class, I want you to like, to share, and of course, don't forget to subscribe to our YouTube channel, Accounting and Finance Coach. On YouTube, it is Accounting and Finance Coach. Share our videos, invite your friends, especially accountants and people who want to be accountants. so that we can demystify most of what you think are difficult in accounting. Thank you very much, and keep a date with me tomorrow for another good one. Thank you.